Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, sometimes it's important to go back to the basics, and I thought, what are the first few problems or challenges that investors face when they're investing in the mutual fund space? The first thing that a new investor faces is the paradox of choice. There are just so many options available to them. Take just the sectoral and thematic category, and you have over 200 schemes to choose from. So how do you choose the right one? So what I thought is, let's have a very basic question asked. If you're looking at an equity mutual fund portfolio that you're building, can you do a one-third, one-third, one-third allocation, which is one-third towards large cap, one-third towards mid cap, one-third towards small cap? How has this kind of a portfolio done over the past several years, and what is it likely to yield you over the course of the next decade to 2 decades if you do a simple 10,000 rupee SIP that is divided into these 3 categories? And that's exactly what I asked my experts today, or my guests today. There's also the 15-15-15 rule, and that a lot of people promise is the way to become a crorepati in 15 years. We'll talk about whether or not you should follow something like that. But joining me today is Prableen Bajpai, the founder of FinFix Research and Analytics, as well as Juzar Gabajiwala, who is the director of Ventura Securities. Thank you so much to the both of you for taking the time. Prableen, I'll start with you. And I must say that both of you have slightly nuanced approaches to or responses to the question that I posed at the start. And what you're saying, Prableen, is that it's a decent start for somebody to make, even though it's a simplistic approach. Why are you saying that?
Hi, Alex. Absolutely very interesting conversation, because it definitely makes the process of investing very simple for a young investor who's starting off for the first time. So if we establish few basic assumptions that, the risk-taking ability is high, and we do have a longish horizon, which is at least 7 years and upwards, I think a simple one-third allocation across the large caps, mid caps, and small caps can be quite effective, especially in the beginning of the journey. This is because this can actually simplify the whole process when you're starting off, let's say, with a 10,000 SIP, which fund to be selected. It is hard. That choice is hard to make for a new investor. This one is a low maintenance way, I think, to balance your portfolio and risk, because you're just choosing the broader category, and you pick any one fund, depending on an active strategy or a passive or a mix of the two one wants to create. I think it can give and deliver decent returns over a longish time period. And I think it can be, it can actually sort of navigate the investor through different market cycles and allow him or her to have a double-digit return in the portfolio over a longish period of time. And this is also important because, Alex, we feel that small caps are riskier, so maybe a smaller composition. Mid caps, they come with their own factors. But honestly speaking, when investors initially, especially youngsters, when they're trying to design a portfolio for themselves, recency bias is so high. So if you know that you have to put one-third into each, irrespective of whether the markets were good, bad, whether small caps looked good in the past or not, and one can stick to this particular mechanism of holding this throughout a longish time period. The returns have been good. I've tried doing the calculations myself, and I think it can work well for an investor.
Okay, we'll talk about the pros and cons of each, but Juzar, first, your thoughts. And I believe what you're saying is that doing something like this would be not the most ideal. Why do you say that?
Thanks a lot, boss Alex, to have me, and I understand where Praveen is coming from. But I think when we look at a younger investor, I'm assuming he's got a long time horizon with him. We are looking at the new age, new Z investors, who are in the 25 to 35 bracket. So according to me, I think you need to do a 50-30-20 ratio, 50% in small cap, 30 in mid, and 20 in large. And the logic being is that I understand that many people think that small caps are risky, but we also need to understand that how the market cap has undergone a change. So today, in fact, a very surprising part is that the small cap company today starts at 32,000 crore. right? So that's the first company, the 251st company, right? The second is that which were around, if you see around in December 2017, when the first AMFI classification was out, it was at around 8,500 crore. So there is a substantial jump. In fact, the company which is a small cap company is, let us say, is Apollo Tires, okay? That is at around 32,000 crore. And in December 2017, it was actually a mid cap, okay? So even though his market cap has gone up and it has appreciated, it has moved from mid cap to a small cap company. The second important thing what we need to understand is that 65% of the corpus is required to be invested in small cap stocks. And if you see on an aggregate across the mutual fund industry in small cap, the general percentage is at around 72%, right? And the balance is more into large and mid caps, right? So you automatically have some cushion over there. And even in the small cap space, the majority of the investment is still up to the first 250 companies or up to 750 where they go to, right? So specifically when a person is looking at an SIP, having a longish horizon is definitely a requirement, right? So if a person is not looking at a 7 to 10 year time horizon, he should not even look at investing. He needs to have a longer term horizon. Again, because an SIP is a product where even if you do for 10 years, still your average holding period is still 5 years.
Yes.
Right? And that is something which investors will need to understand.
Right.
Because the size is here, the size of the companies are going up now.
I get the point. So there's an argument to have a higher allocation towards small cap. So let's talk about the experience here, because by the way, I write a newsletter for NDTV Profit, and the argument that I was making in the last newsletter, which is last week, is I was talking about the performance of the broader markets since the low point on the 7th of April and the move up from that point. And I will draw your attention to the fact that the mid-cap index and the small-cap index are up over 20% from that point. But in the start of the year, there were 2 months, January and February, where they dropped over 10 percentage points in each of those months. So over 20 percentage points of drop. For a lot of investors that are invested in both the mid-cap and small-cap space, their experience would have been that their hard-earned money has gotten eroded very, very quickly. And so there would have been a lot of fear. And I'm sure that a lot of you have that both of you and a lot of your peers have got frantic phone calls saying, ab kya karna hai, mera paisa doob raha hai. So that is the point that I'm making, Prableen. First, I would like you to answer this. What I'm suggesting is avoiding that kind of a drawdown. So while a small cap can potentially give you substantially higher returns, it comes at the cost of higher volatility. So you could go through a period where your portfolio is dropping very dramatically. If you don't have the gumption, or if you don't have the ability to hold, then it might be problematic. Would you agree?
Absolutely, Alex. I think whether it is a 1/3 portfolio or the 50% in small caps, in each of those, the investor has to be prepared for huge downturns. And I'll just give you some data here. The first. So if you're looking at a 1/3 portfolio, so over the last 15 years, if we look at the worst performers in the specific category, so worst performer in the large cap, worst performer in the mid cap, and worst performer in the small cap. Firstly, the point I'm trying to establish here, that the small cap is not always giving better returns than the mid cap. So over a 15-year period, if you're choosing the worst performers, then the mid-cap return is actually higher than the small-cap return. And if we look at the best performers over a 15-year period in terms of SIP returns from the large-cap, mid-cap, and small-cap, then again, the mid-cap and the small-cap returns are there's a 0.2% difference between how the best performers from these two categories are. So point number one, that small-cap will not always bring a better return, given the best case and the worst case scenario. Even if we look at the last 8 years in terms of, when we've had more indices, only 2 small cap funds over the last 8 years have been able to beat a mid cap index, the momentum index, and only 1 mid cap fund has actually beaten that index. So number one, Alex, that of course higher return is not always coming that if you want to take higher risk, it's not a sure shot that you're going to get higher returns. But of course, during this journey, whatever proportion they choose to make, they have to be prepared for the downside to the tune of 40 to 50% as well. So since in the last 15 years, if we see the worst downturns in the small cap and mid caps, the ones I've taken, the worst performers and the best performers, the worst has been about 58%. And the lowest has been roughly about 41%. So likewise, the second worst downturn and the third worst downturn, they're all 30s and 40 and 20s. So investors have to be prepared for that kind of volatility, Alex. And without that, I think, I already mentioned that there is no point coming to equities and taking allocation to mid caps and small caps. And there can be periods of frustration as well, when probably for 2 or 3 years also your SIPs can actually be negative. So it's not easy. It's easier said than done. It looks simple. The formula is simple, but whatever proportion you take, you have to stick through the whole cycle. You have to stick during the time period that you've decided.
Okay. So therefore, on paper, it sounds incredible, but let's drive home that point. You've given us a few values. Juza, from the strategy that you've pointed out, you've also talked about what could potentially be generated. So assuming that there is the stability, there is the holding on during periods of downturn as well that we've just spoken about, what could a 10,000 rupee SIP over the course of the long term yield?
So, if you look at, when I'm investing in a small cap fund, then obviously I'm actually looking at a slightly higher return, right? That's the reason why I'm going to small cap, right? And when I'm looking at a slightly longer time horizon, we have assumed that since I'm talking about a 15-year time horizon, so one is that volatility is bound to be there, whether you invest in large, mid or small cap, and we can have various data points the way we want it to show whether the picture is good or the picture is bad, right? So we have just assumed that what a person should ultimately be satisfied with. Ultimately, that is the return which he has to make in terms of his portfolio. So we have just assumed that a small cap will give you a 16% over a period of time, mid cap will give you 2% lesser, and a large cap 2% lower than mid cap. So anything which is above that, a person is always going to be absorbing it, right? And the problem is that if the returns will go below that, so the weighted average return comes to somewhere around 14.6, right? And the point which I am trying to prove and talk about over here is that over a 15-year time horizon, it will still give him around 60 lakhs with a 10,000 SIP. But if he changes this period of horizon to 30 years, it suddenly extrapolates to 5.2 crores. So the important is that to have the power of discipline, the patience is very in very short measure with most of the investors. We are seeing the SIP closures, and that's where we actually come in. Patience is very important. Being invested in the market is more important because things can just change very quickly. And how does compounding work? That is what somebody the investors need to understand, the power of compounding. And if we are able to make his journey better and by holding on to his investments, that is more important. Otherwise, the average holding period is not crossing 3 years and 4 years. So the most important thing required is there being longevity. The returns will fall into place. Whether you do small cap, mid cap, large cap, whichever percentage you do it, it doesn't matter.
Fair point. And so, by the way, what we're talking about at this stage is just a standard 10,000 rupee SIP over the course of multiple years. We're not even talking about incrementing it. And basis the asset split that Juza has suggested, which is 50 towards small cap, 30 towards mid cap, and 20 towards large cap over a 15-year time frame, assuming what he just pointed out was a rate of growth of 14.6%, you would get about 60 lakhs over the course of 15 years and 5.2 crore over the course of 30 years. So look at the kind of dramatic increase in value because of compounding that kicks in after that 15-year time frame. And Prableen, this is the truth for any portfolio building. the hard work is done in the initial stage and then your money starts working for you. Basis that one-third rule, what have you found could be the best sort of returns that you could get, or rather the portfolio building that you could get?
Yeah, I think, Alex, one very important thing here, because let's say we are only taking 3 schemes overall.
Yeah.
It's also important to diversify across fund houses, number one, for investors, and also styles. So the worst case, which I talked about, that the worst large cap performer in the last 15 years, mid cap and small cap, when we observe and we take out the weighted average returns, they come out to be about 14.54, which is very close to what the calculations which we've done so far. So 14.54 is when you're picking the worst from all the 3 categories. But there is also some commonality that all the 3 schemes are using the same investing philosophy to some extent. But the best case scenario in the last 15 years, when we look at that, the returns by the one-third strategy which we're able to get is about 19.8. Of course, this is in the past, Alex, and we don't know the future returns. But in the last 15 years, if we are looking at this weighted strategy, 19.8% return is what we could have got. And this, interestingly, the schemes which came on the top of their particular categories, also bring in different styles of investing, which is very interesting because one is actually growth oriented. One is a value and growth blend, slightly tilted towards the value. And the third one is little momentum tilted. So I think that is also very important when investors are taking this sort of an approach, irrespective of the percentage. I think bringing in different investment styles can be very helpful, and definitely diversifying across AMCs so that the different style automatically can come into play, especially if they're choosing the actively managed funds.
Okay, let's go into some of the details here then. And you've pointed out some of the pros and cons. I think we've established that over the course of the conversation so far. So let's look at certain options that can be constructed. Prableen, you have suggested a full passive approach, a full passive approach and a mix of passive and active. What are the pros and cons of each? And can you talk about individual schemes as well?
Yeah, so all passive approach, large cap will be Nifty 50 equal weight strategy. Alex, it definitely beats the Nifty 50 strategy over a long period of time. And what it brings is the value style of investing, because only 2% and that auto rebalancing is done at scheme level. In the mid cap, I would say it can be 150 or the mid cap momentum as well, because then the momentum style comes into play. So within the passive, it can be, of course, investor's choice, but I would say momentum would bring in another different style of investing. So that can be picked. And of course, over the last 8 years, since the index is, the index has been there. And if you're just seeing this sort of, since, we've seen more and more investors coming into the market, this particular index has beaten all small caps and all mid caps. Of course, it's got its own periods of downturns and, low performance and underperformance. But at this point, only 2 small caps and only 1 mid cap has outperformed this particular index. And from the small cap to bring in the growth style of investing, because that is a market cap based index. If you want an all passive portfolio, it can be the small cap 250 index. And if you're looking at a mix of the two, I would keep my large cap and mid cap still as passives. So from the mid cap again, it can be the market cap based 150 or the momentum index. But from the small caps, then I would say that, okay, probably actively managed fund can be taken, and something which has a little track record, at least 5 years, and, based on different factors of how the up-down capture ratio has been and rolling returns have been, investors can choose a fund from there. So a combination of the two, but all actively managed portfolio is not my recommendation.
Okay. We'll get into some of the schemes that you have identified, that you've shortlisted, not necessarily recommendations, Prableen, but in the small cap category, what looks good to you. In the meanwhile, let me go to Juzer. Juzer, you've talked about a few scheme names, and I'm quite curious about how you're going about the construction here. Let's start by looking at the allocation, the large, mid, and small cap, one by one. Let's talk about that.
Yeah, so basically, and see, first of all, I think one thing which one needs to be very clear about is that when you're talking about a 15-year time horizon, right? I mean, so we are talking about somebody doing an SIP from now for the next 10 years or 15 years. One thing what is going to happen is that even the returns are going to moderate, okay? So the first most important thing which each and every investor will need to start understanding is that what has happened in the small cap and mid cap space, that is not going to get repeated in the future. The same thing is also going to happen for large caps. As we also see the inflation also moderating, we may still get there is in fact a reasonable study itself is there that your returns from your equity funds generally track around 3 to 4% of inflation. So as we see inflation moderating, the returns will also moderate. The year, what we have basically tried to look at is in terms of how they have performed, in terms of size, and the other thing is that we have tried to see that try to take a diverse fund houses, some new age, some the older ones, right? So that is how we have basically looked at, and in fact now the new ratio which is come in terms of the information ratio, that is actually giving a lot of a key factor to us, and since that is available, so for us the information ratio also is one of the parameters which has been looked at, and even the beta of the fund. And obviously performance is also a parameter. But apart from that, we also look into now various ratios, and based on that, we have tried to create a structure and also have funds from the old age, new age, and plus try to ensure that give a diverse fund house rather than concentrating on one particular fund house.
Okay, and while you've been speaking, we've had that on the screen, the ones that you've selected in each of them, and what you've provided essentially is the rationale as to why you've selected each one of these. Now, the last leg of this conversation has to do with a thumb rule that often gets talked about on social media, and I mean, it's a thing with big numbers, right? Because when you talk about 1 crore in 15 years, it sounds like it's an incredible thing that has been achieved. There is a 15-15-15 rule, Prableen. What does it entail, and why does it capture so many people's imagination?
Everybody wants to be a crorepati, Alex, and ekdam simple tarika hai to know how you can reach there. So it's got 3 factors. It's got the SIP amount. So 15,000, like 15,000 is the SIP. 15 years it is your investment horizon, and then 15% is the assumed returns. So of course 15% is slightly on the higher side, and that is where the catch is that one has to be careful that if you're assuming, like sir also mentioned that 15% probably we may or may not get. So going with 12% would be more realistic. But if we do this math with 15,000 SIP per month for 15 years with 15% returns, we reach that magical number of 1 CR, which everybody wants to achieve as soon as possible. And very interestingly, if we just extend this further, Alex, so let's say that we take this 13-year period and then we keep doing this 15,000 every month for 30 years, 10 crores is the number that one can reach. So it's a very interesting formula. It definitely tells us how compounding works, but compounding tells us and gives us the final figure. The journey is not linear. It's non-linear in equities, and that is what I think that is where the gaps arise, and investors sometimes give up on equities.
Yeah, the job of the financial advisor is not an easy one, Juza, because you have to paint this picture, but you also have to advocate caution. And despite the fact that the long-term averages or the long-term growth of something like even the Nifty 50 is pretty decent, it comes up to very close to that 14-15% mark. It's still something that you shouldn't take as a given. So I guess that is the big drawback of something like this. But having said that, directionally, it's a great thing to do, right?
Yeah, so actually the, like how Praveen said, 15,000 easy for the investor to put in, 15% return, yes, he likes it, right? The problem is the 15 years, okay? And that is the place where people falter. Because and they expect that the advisor has said that it is going to be at 15%, so he expects a linear jump, but he doesn't know that it is actually going to be more like a cardiogram, and that is the thing which he is not prepared for. And I think that's one of the biggest challenges. 1 crore sounds very exciting, but that journey is like they say, there is no pain, no gain, right? So I think, and you will never get a 15% return, that is also a given. Either you will be somewhere below that or you may be, much higher than that, right? And if it is much below, investor will come and tell you that you talked about 15%, I am getting only 14%. 14% is not a bad return, right? And if he'll get 17 and 18%, he's not going to tell you anything.
Yeah, that's a good point. So, but having said that, the idea that we're trying to convey is that you should keep your SIPs going, and the best time to do that, of course, is when the market is not performing too well, because you don't need the money now, and you can capture the benefits. If you had not stopped your SIP in February, then you would have managed to get the benefit of that 20% rally that we've seen in the broader market. So both of you, Prableen as well as Juza, thank you so much for joining in and for giving us a perspective that you did give. And I think for me, what the big takeaway is that you can have a simple approach to investing. You can avoid that paradox of choice by having a simple allocation. A one-third, one-third, one-third allocation in equity might seem a little simple to begin with, but it can yield you pretty decent returns, and you can build that complexity as you experience more in the investing landscape. That brings us to the end of this edition of Your Money Matters. It's been an absolute pleasure bringing it to you. Do stay tuned. This is NDTV Profit.